Hello friends, how are you all doing? Hope your preparations for final exams are all on track. Today we will learn about goodwill adjustment in case of retirement of a partner. So first of all, let us understand the term goodwill. Now what is goodwill? Goodwill is an intangible asset. So what do you mean by intangible asset? Intangible asset means the one which we cannot see physically or touch it physically. Means it does not have physical existence like your fixed asset, like your plant, machinery, or building. But still, it is an asset which is shown on the balance sheet asset side. Now, goodwill is classified under intangible asset, and intangible asset is covered under the accounting standard number 26, where they have specified that goodwill would be recognized in the books of accounts only when money or money's worth is paid for it, which means when it is a purchased goodwill, then only it would be recorded in the books of accounts. So now what do you mean by purchased goodwill? Purchased goodwill means suppose you have purchased a business and you are paying purchase consideration for it, and the amount you're paying for it is greater than the net assets that you are getting. Then you're paying more. That extra amount that is being paid is called as goodwill, and this goodwill is the purchase goodwill which is going to get recorded in the books. So I hope that is clear. Now once we know that what type of goodwill is recorded, now let us see what is the type of goodwill which is being valued at the time of retirement of partner. Now you know when a partner retires from the partnership firm, he is going to leave the business and whatever is due to him has to be paid off. So now you know the capital balance is due to him. You know that his share of accumulated profits will have to be given to him. Similarly, whatever is the goodwill of the firm at the time of retirement would be valued, and his share in the retirement, in the goodwill at the time of retirement would be computed, and his share of goodwill will have to be given away to the partner. But at this point of time, you do see that there is no consideration being paid for this goodwill. And therefore, as per Accounting Standard 26, you cannot recognize it as goodwill in the books of accounts. So that is the important point here, that at the time of retirement of partner, no consideration is being paid for the goodwill, and therefore you cannot recognize it as goodwill on the asset side of your balance sheet. It is not going to get recorded in the books. So once that concept is clear, now how do we go about adjusting goodwill at the time of retirement then? Normally, we adjust it through the partner's capital account. So we would be passing the journal entry through which we will be debiting the partner's capital account, crediting the partner's account, and adjusting the value of the goodwill related to the retiring partner. Now that we will see detail in further slides. Now before moving on to that, first we will see the case where there is goodwill already existing in the book and where there is no goodwill existing in the books at the time of retirement of partner. So first case we'll take is where goodwill does not exist in book. Means on the balance sheet asset side you do not have any value of goodwill already existing. But the partner is retiring now, and at the time of retirement the goodwill of the firm is valued at a certain amount. Then using that value of goodwill of the firm, we will find out the share of goodwill of the retiring partner, and that will have to be given to him. And who will give it? It will be given by the gaining partners. So the first step would be calculation of the gaining ratio to see who are the partners who are gaining on retirement of the partner, because those partners are going to be compensating the retiring partner. They would be giving the goodwill in their gaining ratio. Second, we will compute the share of goodwill of retiring partner. So they will give us the goodwill of the firm at the time of retirement. We have to multiply by the profit share of the retiring partner to find out the share of goodwill of the retiring partner. That amount will be given by the gaining partners in the gaining ratio. So the third step would be pass the journal entry. And the journal entry is gaining partners capital account debit to retiring partners capital account, and the gaining partners will be debited in their gaining ratio. So this would be the journal entry passed when already existing goodwill is not there in the books. Now we will move on and see the case where goodwill exists in the book. Means on the balance sheet asset side you have goodwill existing in the book. Now that goodwill has to be given off, has to be written off. And therefore the first entry would be to write off that goodwill. That goodwill would be given away to all the partners in their old profit sharing ratio. All partners means including the retiring partner. All the partners capital account would be debited and goodwill account would be credited to nullify the debit effect of goodwill appearing in the balance sheet. So the journal entry would be all partners capital account debit to goodwill account in their old profit sharing ratio. And then we will go to the case where goodwill is valued of the firm at the time of retirement, and we will apply the same procedure as in this case. We'll find out the gaining ratio and find out who are the gaining partners. Their capital account will be debited and the retiring partner's capital account will be credited with his share of goodwill. So this way the accounting treatment for goodwill would take place in the case of retirement of partner. So let us understand this particular concept using an example to get clarity. So I've given you an example here. X, Y, and Z are partners sharing profits and losses in the ratio 3:2:1. Goodwill of the firm at the time of retirement of X was valued at 36,000. So this is the goodwill of the firm at the time of retirement of X. So X is retiring. Past necessary journal entries in case 1, no goodwill exists in the book. 2, when goodwill existing in the book is 24,000. So as I said, first you will have to find out the gaining ratio. Now here from the reading of the question, we find that they have not given the new ratio, new profit share ratio amongst Y and Z. So we cannot calculate gaining ratio using the formula of gaining ratio. And they have not also given any specified ratio in which it is going to be taken over by Y and Z. So here, as nothing is specified, what do we assume? We assume that the remaining partner, that is Y and Z, would share in their old profit sharing ratio and they will also gain in the same old profit sharing ratio. Therefore, what would be the gaining ratio? It would be same as the old profit sharing ratio of 2:1. Now, we will take the two cases. First case, there is no goodwill existing in the book. Therefore, directly we will be dealing with this goodwill of the firm which is valued. We will first find out the share of X in goodwill. That is 36,000 into his profit share. X is sharing 3/6. So 3/6. It comes to 18,000 rupees. So this is the share of X in the goodwill. Now this would be given by Y and Z in the gaining ratio of 2:1. So gaining ratio here is 2:1. Therefore, what would be the journal entry? We would debit the gaining partner's capital account. So Y's capital account debit. Z's capital account debit to X's capital account, that is a retiring partner's capital account. Now that would be 2/3 and 1/3 being the gaining ratio. You'll multiply, you'll find out 2/3 of 18,000. That would be 12,000. So X would be contributing 12,000. Y would be contributing 1/3 of 18,000. That would be 6,000. And totally they will give to X his share of goodwill in the firm of 18,000. So I hope that is clear. Now we take the case where already existing goodwill in the book is 24,000. So what do we do in this case? First you give away this existing goodwill 24,000 to all the partners. So goodwill as a debit balance, to write it off, we have to credit it and we would debit all the partners' capital account. So first journal entry that you will pass would be, you would debit all the partners' capital account. So X's capital account debit, Y's capital account debit, Z's capital account debit to goodwill account. That is this 24,000 existing goodwill. In what ratio? In their old profit sharing ratio of 3/6, 2/6 and 1/6. So 24,000 divided by 6 would be 4,000. So 8,000 and it would be 12,000. So X's capital account debit 12,000, Y's capital account debit 8,000, Z's capital account debit 4,000 to goodwill account 24,000. So we have dealt with the goodwill existing in the book. Then we come to the goodwill valued at the time of retirement. Go through the same exercise as we have done here. The same thing would be repeated and we'll pass the same entry. The same entry would be passed here too. That is, you find out and we would debit the gaining partner's capital account with 12,000 and 6,000 and credit excess capital account with 18,000. So this is how the goodwill would be dealt in this particular case. I hope that is clear. Now, I would also like to discuss with you the case where the two ways in which goodwill at the time of retirement could be dealt with. They can tell that you adjust the goodwill at the time of retirement by without raising the goodwill in the books. That's one situation. Or they might say raise the goodwill in the books. But as per accounting standard 26, you are not supposed to show, you cannot record the goodwill at the time of retirement where you have not paid money, so money is worth. Therefore, if you raise it in the books, you will have to immediately write it. So what would be the journal entries and accounting treatment when they have given you such case? If the goodwill is at that time of retirement and it is not raised in the book, we already know we would adjust it through the partner's capital account and the entry would be gaining partner's capital account debit to retiring partner's capital. But if they say that you have to raise the goodwill in the books and then write it off, thereafter write it off, then what you will do would be you would debit the goodwill account debit. You have created the goodwill and you would credit all the partners' capital account and give it away in the old profit sharing ratio. But this goodwill cannot be written in the books because this is not purchased goodwill. This is not goodwill for which any money or money's worth is being paid. So we have to immediately cancel out. So immediately pass an entry where you credit goodwill. But here at this point of time, you'll be debiting the continuing partner's capital account. And this would be done in the new profit sharing. So if you ultimately see, the net effect of these two would be the same as this particular entry. So to understand this concept better, we will take up an example. See, A, B and C are partners sharing profits and loss in the ratio 3:2:1. C retires and the goodwill of the firm at the time of retirement is valued at 72,000. Pass as an entry for adjustment of goodwill when goodwill is not raised in the books. Second, when goodwill is raised in the books. So first case, when goodwill is not raised in the books, we know the adjustment is through the partner's capital account. So first, we have to calculate the gaining ratio. Here again, nothing has been given. The new profit sharing ratio has not been given or specified ratio has not been given. So we assume that gaining ratio would be the same as their old profit sharing ratio, which is 3:2. Therefore, now what we have to do, second step, calculate the share of C in goodwill. The goodwill of the firm is 72,000 into 1/6. That would be 12,000 rupees is C's share in goodwill. Now this has to be adjusted and through the capital account. So the entry would be gaining partner's capital account debit to the retiring partner's capital account with the share of goodwill of the retiring partner. So debit A's capital account debit B's capital account debit because they are both gaining to C's capital account, who is a retiring partner. You're giving it to him. You'll be giving away 12,000, his share of goodwill, but in the ratio of 3:2, that is 3 by 5 and 2 by 5. So 3 by 5 of 12,000, that would be 5 to 7,200 would be debited to A, and 2 by 5 of 12,000 would be 4,800. So this would be the journal entry passed when goodwill is not raised in the books. But suppose they say that goodwill is raised in the books, then first entry will pass is you will debit the goodwill account with the entire value of goodwill because it is raised in the book, and you would credit the all partners capital account. That is, you will credit A's capital account, B's capital account and C's capital account, and this would be in their old profit sharing ratio, which is 3:2:1. So this is 3 by 6, 2 by 6, 1 by 6. So 72,000 divided by 6 would be 12,000. See, the 12,000 to 3 would be 36,000 to A, 24,000 to B and 12,000 to C. So now you raise a goodwill, but you cannot keep this goodwill in the books because it is not recognized on the accounting standard 26. They have stated you cannot show in the goodwill. You cannot raise goodwill and keep it in the books. So we will write it off. So second entry would be where you write it off, but here now you will be debiting continuing partners. That is A and B. So A's capital account debit, B's capital account debit to goodwill account. So this way you see the goodwill account that you raised by a debit here is credited here and it is going to get nullified. So goodwill you raised and wrote it off. So there is no goodwill there in the book after the adjustment. But now this would be the new profit sharing. What is the new profit sharing ratio? Nothing is specified. We assume that they continue in their old profit sharing ratio in between themselves. So in the new profit sharing ratio, it is going to be 3:2. So 3 by 5 and 2 by 5. So 3 by 5 of 72,000. 1, 2, 4, 14, 500 into 3, 15, 43,500 and 2 by 5 of 72,000. 14,500 to 2, that would be 29. Sorry, I think there is a mistake in the calculation. Just do it here. 14,400, sorry. So there's a mistake here. 14,400 into 3 would be 43,200 and into 2 would be 28,800. So in this way we debit the continuing partners capital account and credit the goodwill account. So when goodwill is raised in the book, it is written off immediately. Now if you see here, you have credited A's capital account with 36, debited with 43,200. So if you see the difference between 43,200 and 36,000, it is 7,200 debit. That is what is happening. And then B's capital account is credited with 24 and debited with 28,800. So the difference is 4,800 debit. And here you see C's capital account is credited with 12,000 and that is what. So the net effect of these two entries would be the same as this, but because they have asked you to pass the journal entries by raising goodwill, you have to pass these two entries. And if it is without raising goodwill in the books, then you pass this particular entry. But the ultimate net effect of both the cases, the entries that you pass is going to be the same on the capital account of the partners. I hope that is clear. Now, as a recap, let us do some questions to see whether we have understood the concepts. You can pause the video, answer the questions, and then restart it to see whether you're right, whether you got it right. So first one is goodwill at the time of retirement of a partner is recorded in the books. Is it true or false? It is false. We do not record it in the books because as per accounting standard 26, you are not supposed to record goodwill when you're not paid money's or money's worth. So you can create goodwill, but immediately you have to write it off as well. Second question. Goodwill at the time of retirement of a partner is debited to remaining partners in gaining ratio. So at the time of retirement of the partner, we pass the entry where we would be debiting the gaining partners in the gaining ratio and crediting the retiring partner. So that is true. We will be debiting the gaining partners who are continuing. Then, third question. The goodwill existing in the books at the time of retirement is written off amongst dash partners and dash ratio. So if already existing goodwill is there, we have to give it away to the partners. So it is written off amongst all partners in their old profit sharing ratio. Finally, the fourth question. In adjustment of goodwill, dash capital account is debited and dash capital account is credited with the share of goodwill of retiring partner. So whose capital account do we debit? The gaining partner's capital account is debited. And whose capital account is credited? The retiring partner when his share of goodwill is being given to him. We credit his share. So friends, with this I think all of you must be clear about now about goodwill adjustment at the time of retirement. If you found this video useful, please do like and comment in the comment section below. If you are not subscribed to my channel, please do subscribe to this channel to get continued notification of all our upcoming videos. Your likes, shares and comments encourages us to create more such videos for you. Thank you.